going through, I'm at part 3 right now,
Uh-huh.
and reserves not required. Now, you talk about the $200 billion gift you never
Yeah.
intended to give. And I can't recall specifically, but I think what you're referring to is prior to the GFC, the banks weren't paid interest on their reserves. And post GFC, they are paying interest on the reserves. And you pose the very good question, who's paying it? Who's paying for those for all this money that's
Right.
going to the banksters now that they have $4 trillion? Maybe it's down to 3 trillion now, but they're getting all this interest on their quote unquote excess reserves. Who's paying? And then you kind of connect the dots and say it's you, the taxpayer.
Right. Yeah, the Fed is supposed to turn over all of their profits to the Treasury to either reduce the deficit or pay down the debt.
Yeah.
And the Fed, most people would think, well, the Fed will just print the dollars, and that's where the interest is coming from. But they can't just print. They can only print if they buy some. They've got to have an asset to reflect every liability, and the liability are the dollars that they create.
Yep.
And so they have to buy an asset, and those assets that they buy are treasuries and mortgage-backed securities. And so what the profits that the Fed makes that they're supposed to turn over to the Treasury are the interest that those Treasury bonds that they buy by counterfeiting currency into existence. They buy this. The Treasuries pay interest. The mortgage-backed securities pay interest. Where does that interest come from? Your future tax payments and your future mortgage payments. So it's us paying the bill. And since this is not being turned over to the Treasury, but given to the banks instead as a free gift, because Ben Bernanke is the one that shoved, him, and then Powell followed his lead, but shoved all of this 3 trillion, it was 4.2 trillion at one point of reserves on the banks' balance sheets. And then they want the banks to just leave it there. So they started paying interest. So it was a gift. The banks didn't even want this excess currency. They got by with just $40 billion roughly.
Yeah.
They didn't need 4.2 trillion. All they needed was 40 billion with a B. And that was enough to make the whole system work. And then there was required reserves and excess reserves back then. Required reserves, this included vault cash.
Yep.
So you look at loans and leases versus deposits and so on, and you have to deduct currency and circulation, but vault cash is part of their reserves. And so the actual excess reserves that they're using for interbank settlement was just a slim, a tiny little slice of the currency supply. And today it's huge. And now we're paying interest on it. And it is the public that's paying. And they're paying twice, because not only did this not go to the Treasury to pay down the debt, but the Treasury now has to issue more bonds to make up that difference. They've got to issue more debt, and which requires us to pay, and your children and your children's children will be paying for this. And it was all Ben Bernanke's great idea back in 2002.
Yeah. And, makes it even more crazy, Mike, is as Jerome Powell increases interest rates, that's more and more interest that he's paying the banksters.
Yes.
Because just for clarification, and you just nailed it, the reason they have to pay interest on those reserves is because if they didn't, there's so many reserves in the system that the natural interest rate would be zero at all times. They wouldn't be able to raise the Fed funds rate. So as they raise the Fed funds rate, that just exacerbates what you're talking about. More interest to the bankers, then the taxpayer inevitably has to pay. It has to give up more of their purchasing power to Jamie Dimon, basically, as the Fed tries to quote unquote fight inflation.
Yeah, if you take the $3 trillion roughly that the banks have the reserves have shrunk from 4.2 down to about 3 trillion. But we're at what, 4.6 now on the Fed funds rate? Take 3 trillion times 4.6% divided by 12 months, and you'll find that we're paying them about $11 billion a month, that it's raining free currency on these banks. Normally, they would have to work for currency. They would have desks and power being consumed and have to make an investment in computers and phones and employees, and they would have to work for that. They're getting $11 billion a month of very high power currency because it's just pure profit to the bottom line. And a couple of parts later, I show the correlation of this raining of free currency on the stock markets rising. And so right now, the stock markets rose for a while, and they broke a downtrend line, which is a positive thing. That downtrend line should act as support when the crash starts to continue.
Yeah.
And I said in the book that because of this interest, and this was written back in October of last year, because of this interest, we will probably see some sort of bear market rally in the middle of this. This is a correction of a warping of the. That's what people need to understand, and that's the reason they should get the book, is because this is a warping of the economy where wealth is being transferred from Main Street to Wall Street, the financialization of the economy, and it pumped the markets and the low real estate, the low interest pumped up real estate into massive bubbles that need to be corrected. And when you get into chapter 5, which is the almost everything bubble, I show the scale of the bubbles. And then there's 2 economists out of Europe that had done a study where they took 17 advanced countries and looked at their stock market capitalization to the GDP of the country going all the way back into the 1800s. We never had data before that went back before the 50s on the Buffett indicator, the size of the economy compared to the value of the stock markets. And so a lot of people thought this upward trend over time was natural, and it is not natural. We've been in a hyper bubble since the late 90s, and during the global financial crisis, they only allowed it to come down and barely touch fair value, and then they papered over that financial crisis and drove it into another hyper bubble. And so now we've got the almost everything bubble, but this distortion is all caused by papering over everything. And those things eventually break. And so there's going to be a wealth transfer, and you will participate. Everybody that has, everybody around the globe will participate to one extent or another.